Hey traders, welcome to Charts and Coffee. And bear with me one moment. I got to get the essentials room in the conversation here. Good morning. Good morning. So we are taking a look at another down day in equities. And let's see, let me get the essentials room in here. All right. Good morning, essentials room. Good morning, YouTube. Welcome to Charts and Coffee. All right, let's get to it. A couple of things I have here on the notes on the left side of the screen. And what we have here is Powell tomorrow, non-farm payroll tomorrow. And so far, a pretty down day in the equity markets. Let me show you all before we get started, taking any questions that you might have. And Bob, I see your question there about some PE ratio stuff. Yeah, we can talk about that too. If you have any questions, type them on in. And all right, this is what I wanted to start off showing everybody. So yesterday, there was a pretty decent rally in the late part of the day. And most of that, by the way, gang, I sent this out to my mastery folks in the afternoon. I said, right now, the short squeezes are happening when we get a tariff delay. So initially, when the tariffs were placed, equity markets would sell off because of the uncertainty. Now, when those tariffs are being delayed, they create almost instantaneous short squeezes. And so the why does matter. Was this just sudden buying in the S&P based on demand or some sort of, economic shift? Or was this basically news? And this was news. And I think it's super important as we go through this year and this first quarter to remember that the why is going to matter. I don't want to get caught up in headlines. I don't want to trade them, but we do need to know why something might be heading higher. And you can see the news for the tariff delay, potential tariff delay, is instantaneously when we saw the S&P head higher. The S&P then headed higher from the gray zone. By the way, that low was in the conservative edge of historical volatility. In fact, this wasn't even a volatile day. So let's talk about what volatility is. Volatility is not price movement alone. Volatility is, are we going outside of a typical probability? Now I use a 68% probability. It's a standard deviation, right? So are we moving outside, quote unquote, normal? Now I'm going to let you know what I think normal is. Normal is roughly what we do 2/3 of the time. We could calculate different normals, but I think it's important to know what my daily price movement ranges are using as a normal. We did not exceed the normal daily price movement range yesterday. We simply went from one edge of historical support, volatility based, to the other edge, right? So that was not a volatile day. Just because markets move suddenly doesn't make it volatile. So let's keep that in mind. All right, so market rallied up, S&P rallied up, hit the top edge of an expected volatility range. And I'll squeeze in even a little bit more so everyone can see that candle. It's this one right here from the 5th. See the wick at the bottom? See the wick at the top? That's within normal. Yes, it pushed it on the edge, outer edge of the boundary, but that's normal. But we rallied up into resistance. That gold zone, gang, is volatility-based resistance. And I'm telling you, not 1 in 10 traders are understanding that the word volatility isn't just up and down movement. It's where are we going? Is it outside the norm? So let's go back to the 4th. That was outside the norm. Right? Someone says ROG was the 4th volatile. Absolutely. ROG was the 3rd volatile. Absolutely. So we've had a lot of high volatility days where the 68% probability was smashed. What we typically expect 2/3 of the time, we way exceeded. Yesterday was not. And actually, so far today is not either. So yesterday, within a very normal volatility, we went up to the upper end of the day, and that resistance, and here we are heading back lower. That's to be expected when the candles are red and we have normal volatility. And this so far is normal. Now you might say, Rod, give me some thresholds. All right, when would it stop being normal? For example, today, I can tell you right now. Look at the chart to the left. And this is what daily price movement ranges do. It's sanity in a world that feels right now in terms of price movement absolutely bonkers. Yes, that's a technical term. 58, call it 53, would be the upper reaches of normal volatility today. And on the lower end, it'd be 57.60. Well, actually 57.70, right? Now, there are standard deviations beyond the 68%, and that's what the green and red lines above and below are. But we're very much trading in a normal environment at the moment. And the short squeeze based on tariff delays, when we see that, that should be something very hesitatingly taken to the long side. You get a short squeeze, great. Take the profit, move to break even, do whatever you need to do to lock in some of that profit. And then remember, we're in a bearish environment on the S&P, and we hit the resistance yesterday. And I'm not going back to tell you what already has happened alone. I'm going back to show you what you can see and the why, so that when these things happen, they're in better context. All right. And so that is the S&P. Yesterday was normal volatility, and so far today is, but obviously the bell has not rung yet. The last 4 or 5 days previous to yesterday, the last normal volatility day we had was on the 26th of February. So yes, we've had a prolonged period of time where volatility was exceeding normal. Volatility is not the bad guy, right? It's not the enemy. It's unusual volatility. It's unusual movement outside of the norm. All right. So I wanted to point that out because I think a lot of folks are, struggling with the volatility. If you wake up in the morning and the S&P is already, and this has not been unusual, the S&P is already crushing that 68%, we know it's going to be a weird day. We know stop losses are going to be difficult to place because we're not dealing with normal, right? Okay. So hopefully I drove that home. Bob was asking about, so Bob, I've been spending probably the better part of the last 2 years or so, the kind of question you have here, and let me read it for everybody. What's an easy and reliable way to find average PE ratios for the first 5 years? Bob, I don't look at PE ratios, so I guess I should start there. But beyond that, I've actually started to build some very good prompts using AI. My preferred AI is Perplexity. I like Perplexity a lot. And I tend to use theirs, but you can use ChatGPT, you can use, whatever. There's a huge list. I won't go there, but I use AI very actively in my investing research and just in research in general. So the trick to using AI, though, is having and knowing how to write a prompt. And that might be a cool conversation to have sometime in the future. But what I usually do is just go and ask AI with a well-researched prompt. And so to answer your question, I did that before the show started. The average PE ratio for Google over the past 5 years is 24.5. 24.5. And the range has been from 19.3 to 29.7. And I'll just put together a well-written prompt, and then I get some very good information. And that's typically what I do. So I also want to mention that's not really a big part of how I invest. I don't even look at what I do as investing. I'm not looking at fundamentals, or as one of my mentors used to call them fundamentals. I don't look at those. I look at weekly time frames. I look at a lot of things we're talking about when we're trading: price, time, volatility, volume. I use that, and then I'm able to put on what I would consider to be a long-term trade. I think investing is a cool word, but let's talk about trading versus investing, because I think this question also kind of needs a little bit of clarification. If I'm in a trade for 20 years, that's still a trade to me, right? Obviously, the tax implications and things like that are different. Being in shares and not options, obviously, are a necessity. But I look at everything I do as a trade. Someone said, Raghee, you an investor? I don't really consider myself to be an investor. I've been managing my mom's portfolio of trades for, since I was just about 20 years old. I'm going to be 54 this year. And I would consider almost every position, except for the ones that she put on before I started managing it. I would consider them all a trade. And I still think like a trader. And I think even investors would behoove themselves to think like traders versus I'm just going to buy and hold for forever. So that's another reason I don't use fundamentals. All right, next up is, let's see, questions. Bear with me. TAP. It looks like it's setting up for a mean reversion, Jas. Yeah, so you get a trend. And because the trend is on, based on my indicators, you can see here the multi-structure, that will light up the zone automatically for a mean reversion, which will not trigger till about 58.20. Till about 58.20. All right, Stefo asked, thoughts on Uber on the daily? So Stefo, I don't use 50 and 200. I think most traders are taught to use 20, 50, 100, 200 at some point. I find them very laggy and they're price-based only, right? So two things I do with my moving averages. Recency bias, I think we could all agree is real. What happens more recently has a more impactful effect on mindset, even mindset and math, than say what happened 2 months ago, 2 years ago. So I like the recency bias that, say, an exponential moving average offers versus simple. Now, it's probably not going to be that different, and obviously opinions will differ, but I like an exponential moving average over a simple moving average because it bakes in the human nature of recency bias. So that said, I don't use those. However, what I would say is the 200 is super important. 200 has a psychology that it's just so widely watched. It is worth watching at 200 SMA or EMA. And that's those are basically the white dots. I've taken that EMA, I've made some customizations to it. So it's not going to be exactly where a 200 EMA would be, but generally in that area. I use a methodology. Just again, I don't want any black boxes on this chart. So I use a methodology that looks at moving average crosses, a shorter moving average crossing another one, which has some value. And then I add in a few other metrics that I want those white dots to consider, as opposed to just a straightforward EMA. But I'm a big fan of a 200 EMA as well. This would be a great bullish play. The candles are green. We're above the equator, which is that 200. But we've had a lot of volatility in Uber, as you can see. Nonetheless, if we're looking to the long side, green candles are the way to do it. And that's where, if you look back on how long Uber's been printing at least 5 in a row, 1, 2, 3, 4, 5, since the 22nd of January, we had the 5 in a row. We had the one crazy candle there, which I would expect that was earnings, right? So I'll kind of separate that out from normal price action. And then after that, Uber's been a relative outperformer in the XLI and in the IYT. All right. Dan says, hey, Dan, it's from the Mastery Room. Hey, Dan, one of our sector Fu Mojo Dojo trading room folks. A conversation on AI prompts would be good. Yeah, that'll be probably something we could do later. We're going through the immersion right now. We're going to get those basics, keep on with our trading in the Mastery. We just closed out 4 winners. We still have 2 that we're scaling out of. So we've got a pretty full book, but that would be a fun topic in the future. That's something I've been doing a lot. Big fan of that. All right. So next up, what happened to my clock? I like when that clock's up there. I tend to lose track of time very quickly in our show. I love the questions. All right, there we go. Let's see. John asks, how do we equate the SPX to the ES to determine where price should be on the SPX? Okay, so John, it's an SPX trade question, right? All right, here we go. I'm going to move that over. Okay. All right. And by the way, before anyone gets kind of intimidated by prompts, gang, even back when Googling was a thing, right? And I think Googling is going to become very extinct because prompting AI is so much better. Prompts are no different than back in the day, someone who could search Google really effectively. It's just a matter of communicating exactly what you want. And a lot of times when I'm prompting, it's really interesting because before you would just ask Google, what's the PE ratio of Google, right? And it would spit out what it's going to spit out and 19 sponsored links and a whole other bunch of garbage before you get to a site that's just going to give you the answer. AI does none of that. How many of you, I'll tell you this, the smartest thing I did, if you have some parents out there who used to Google, my mom's going to be 80, I think. Perplexity is her best friend. The other day, for my folks who love South Indian food, My mom wanted to make masala dosa, but she wanted to find a quicker way to ferment it. She asked Perplexity pretty much that. Perplexity gave her an answer. Said, okay, use some Eno and it will ferment your masala dosa dough really much quicker. It's amazing. But then I told her, I said, tell Perplexity a few other things. And she did. I taught her how to sort of prepare the prompt. And those are all things that it's just a matter of, it's not about figuring out code. I'm not asking AI to code anything for me. I'm really asking it questions in a different way. So yeah, I don't want anyone to get kind of caught up on the prompting thing. All right. Equate SPX. So John, I don't want to equate it. What I'll mention is for those of you that trade SPX, this is the way I've taught it, and this is the way that I do it when I do. If I'm going to trade SPX, and SPY would be part of the same conversation, what I would do is just look at the ES. So I don't need to equate it. What I'll do is, for example, I'll pull up on my platform. Let's say I was going to trade the SPX. I could pull up SPX on the option, right? And I'll make sure that it doesn't change my chart. So now I can look at SPX and I just know what the option chain is doing and where it is trading. The only reason I need to look at SPX and SPY is the same thing. If you're in the mastery gang, you already know how to do this. Watch ES. When ES has a trigger, we could trade MES, we could trade ES, we could trade options on ES, we could trade SPY. And yes, the same setup would apply to SPX. There are a few things that I teach that are specific to SPX because they're European style options and their time decay is a very different type of time decay as opposed to an American style option. That's the biggest difference. But when ES triggers an entry using my hourly price movement ranges, using my daily price movement ranges, whatever it is, that's when I have what I call the choose your own adventure. So at that point, I could say, hey, ES, the S&P futures that are trading 23 hours a day with pretty darn good open interest in volume and attention, right, is telling me there's a buy. Now, every other instance of S&P, SPY, MES, SPX are going to be triggering a similar setup. So I use the ES to trade every type of S&P setup that I would be looking for. And so I'm not actually trying to do a conversion, right? And the same thing would be like, for example, if you were trading S&P this morning, green is support, red is resistance. If you wanted to buy ES, you could find where that trigger would be within the green zone. If you wanted to short ES, there's your trigger in the red zone. If you wanted to instead trade MES, same thing. Once the bell rings and SPY and SPX now are viable, now you would do the same thing. If someone said to me, Rog, yesterday, I want to be long SPX, not in a million years. Overnight, I'll look at that daily time frame. I see the red candle in the gold zone. That's an overnight SPX long put, or it's an overnight ES short position. And if we look at the version of the S&P that trades 23 hours a day, think about your indicators. And everyone here has different indicators. Think about your indicators right now. If you've got a set of indicators and you're watching SPY, they really don't wake up until the bell rings. ES has been crunching data since 6 p.m. yesterday. I've got that running flow and tally and measurement and output from the Asian session, the European session, the UK session, and the early pre-market of the US. Everything's, as you can see on my charts, already calculating. So when the bell rings, I've already got data that my indicators are understanding and giving me output about, as opposed to, looking at something right at the bell. And now it's having to, play catch up. So one of the many, many reasons I will use ES futures to trigger, set up every instance of S&P. Thanks for the question. I think a lot of folks are looking at SPX, unfortunately to their detriment when they're trading SPX. All right, gang, out of time. As always, thanks so much for being here for Charts and Coffee. Just heads up, tomorrow we've got non-farm. We've got Powell tomorrow, second biggest event, second biggest trading session of the week. And that's going to be a macroeconomically important one. All right, gang, be good to each other. I'll talk with you soon.